Welcome to RAIN, the Real Estate Investor Growth Network with your hostess, Jen Josie. Join like-minded real estate investors and accelerate your business towards greatness. You will hear step-by-step strategies for success, interviews with real estate rock stars, and we will dig deep into past projects where we bear it all, including the good, the bad, and some just plain ugly. So get excited. Here's the bestower of badassery herself, the real Jen Josie. Listener discretion is advised.
Hi, and welcome back. I'm Jen Josie, creator of RAIN, the Real Estate Investor Growth Network. Whoop, whoop. On today's episode, we have a guest that will be sharing their badassery. But before we begin, here's today's badassery bestowment, my little badass gift to you. Today's topic is one of my favorites, education. Let me preface by saying the educational process is a journey, not a destination. One thing I noticed early on in my investment business is that all the successful people in this industry never stop acquiring knowledge. Wealthy people understand that the educational process never stops. They also understand the value of investing in themselves. When I joined my first education program, I was too embarrassed to tell anyone I had spent $30,000. At that time in my life, that was a ton of money. Because I had so much skin in the game, there was no turning back for me. That $30,000 investment in myself has been paid back time and time again through the knowledge I gained from that mastery program. Through the systems and tools I learned, I was able to quit my corporate America job within 8 months. The market is always changing. Technology is evolving, new legislation is getting implemented, and opportunities are always presenting themselves. You do not want to be left behind, so make the commitment today to continuously grow your education. Now, on to today's episode of the Real Estate Investor Growth Network podcast. We have with us Jacob Vanderslice. Jacob is principal at VanWest Partners, a Denver-based real estate investment firm focusing on the acquisition and management of self-storage centers and other opportunistic real estate throughout the United States. VanWest has established a track record with over $195 million in real estate assets. Jacob and his partner's success is driven by a commitment to delivering an expertly executed, adaptable strategy with an institutional investment approach. It is my pleasure to welcome to the show, Jacob Vanderslice.
Jen, good to see you. Thanks for having us on today.
Man, you got some good words in that intro. I'm just saying, I love it.
Yeah, I didn't write those. Somebody smarter than me put that together.
Expertly executed. I'm like, yes, bring it. So
yeah, that's questionable, but we'll keep it in there.
Well, it is a pleasure to have you. And I messaged you before this. I said, I'm going to be having a beverage. And I forgot that you're in Denver. I'm 2 hours ahead of you, aren't I? So,
well, as I mentioned, I'll be starting my beverage at the same time that you did on the East Coast.
Perfect. That's acceptable. So tell us a little bit about Jacob. How'd you get involved in real estate?
I got into real estate investing about 15 years ago. I was in the fire service, had a lot of time on my hands, and I started doing fix and flips on my days off and kind of grew that and got busy doing real estate and quit my full-time job. And I've been unemployed ever since. Did a lot of single family deals over the years. We started doing commercial properties, adaptive reuse retail projects in about 2014, basically converting just old buildings into multi-tenant experience-based retail concepts, breweries, restaurants, gyms, yoga studios. And then we got into self-storage in 2015, and we liked the asset class. We'd studied it for a while, and we started off with a few ground up development projects here in Denver and then expanded to the Midwest. And now we've got 35 self-storage facilities all over the country, mainly in the Midwest and Southeast, and some here in Denver too.
So what is it that drew you to self-storage facilities?
Well, you don't go to high school dreaming of growing up and being a self-storage investor, right? at least I didn't. Self-storage is a good hybrid of real estate and an operating business. And historically, it's done really well during downturns, and it's done well during upswings as well. And we liked how defensible it was, and we liked the fact it was repeatable and scalable and durable, and just like the idea of it. So we got going into it, bought our first deal in 2015, and just kind of kept going from there.
So how is it like flipping a single family home? Do you use the same type of people to finance it? Is it different than that? Like, are you even flipping them? Do you have to flip anything? Tell us the differences between single family and storage facilities.
Well, I think all real estate is fundamentally similar, but then it kind of diverges from there. I guess the similarities across any deal type, you really got to know three things. Number one, you have to know what's it worth when you make it better. And the second thing you have to know is what's it going to cost to make it better. And then if you know those two things, you can back into what you can pay for it. And that's the third thing you have to know. What can I pay? So you can apply that to kind of everything. Beyond that, self-storage deals compared to fix and flips, the gross dollar basis is a bit higher, actually a lot higher depending on the size of the deal you're buying. You're probably not going to go buy a self-storage deal for 50 and put 25 into it and sell it for 100,000. The financing is pretty different too. Single family financing, you can get FHA debt, 30-year fix, pretty high leverage. Self-storage is more like 70% leverage, sometimes a little bit higher depending on the bank. And it's pretty operationally intensive. All the leases are month to month, so you constantly have customers moving in and moving out every day. Revenue management is very dynamic. So if you're buying a deal, for example, in Milwaukee, the seasonality of the self-storage demand changes by the winter and summer, right? It's cold out, people don't want to store. Summertime, people want to store. It's very different than Florida. Versus if you're doing single family rentals, most of your leases are at least a year, sometimes 2 or 3 years, so your turnover doesn't happen as often. So the operation side is very, very different, but it's still real estate, and you got to figure out what it's worth once you make it better and what it'll cost to get it there.
Well, I went in the middle of that just because, we have single family homes that we have to rent out. And when the lease is up and just going through the whole process of screening tenants and stuff like that. But I'm sure you have people in place, even on site sometimes, right?
We do. We have about 60 employees in our operations platform. And there are on-site managers, our regional managers, but the move in and move out or turnover experience of a storage unit is very different than a single family home. There's no security deposit. There's no carpet or bathrooms to deduct from a security deposit if there's damage to them. Pretty much someone just gives us notice, they move out. They're typically leave a clean unit behind, and somebody else moves in. So it's very dynamic, and the turnover process is much simpler than single family or multifamily.
So what happens when people don't pay? Because I see these shows where they auction off the storage units. So have you had any crazy items left behind?
We have. Auctions are kind of a last resort. So typically if someone doesn't pay, our first line of defense is to turn off their gate access code, which obviously you can't do that on a single family rental. You can't go change the locks on the second because you would get in big trouble if they don't pay. So that's kind of the first thing we do. And if they still don't pay over enough time, we'll put an overlock on their unit. So if they do get in the facility, they can't access their stuff. And the last line of defense is we auction the contents. And that's really not to get money for the contents of the unit. It's just to get the unit vacant, get it back online to a paying customer. But nothing I can think of off the top of my head has been crazy that's been left behind. But we have a third party.
No dead bodies? I mean, come on, that's in like
no dead bodies yet. We do have some folks who try to sleep in units overnight sometimes. So we'll become a multifamily operator when we didn't mean to. That's mainly in our more infill locations.
Wow.
For the most part, people are pretty good. But yeah, it's operationally intensive. I mean, you've got theft issues. Sometimes customers will lease a unit and then cut open the wall to try to steal the contents of the unit next door. They'll drive into the gate and break it, or they'll drive into a building with their moving truck. So there's a lot of challenges, just like anything.
Wow. So just ballpark figure, how much does a storage facility cost? Say like 100 units.
Yeah. I mean, it's really variable. Okay. 100 units could be $1.5 million. It could be $2 million. It could be more. Our average purchase price in the last year has been about $7 million. We have deals that have been smaller and deals that have been bigger. I'd say our average self-storage facility size in terms of net rentable square footage is about 50,000 square feet. That seems to be the sweet spot. We'll do deals that are smaller, down to 25, but it kind of has to be part of a portfolio or it has to be nearby something we already own. We have deals that are all the way up to 115,000 square feet.
Goodness. And what do they bring in each month? What's your average?
Our units lease between $50 to $300 a month, depending on the unit size. So it really varies from market to market, unit size to unit size. The more kind of suburban or almost rural markets, we're not really anywhere rural, but lower population densities, typically rents are lower out there than say a multi-story project in downtown Denver.
So you tapped into location here, because that was my next question. You said you're all over the country. So how do you pick where to purchase storage facilities?
Well, the first thing we look at is just good real estate fundamentals, good population growth, good area incomes, a story for an increase in rents. As it relates to self-storage, the first thing we look at are supply ratios. Self-storage is very local supply sensitive. So we'll track how many facilities there are in the 1, 3, and 5 mile trade radius against the number of people that live there. Nationally, there's about 7 square feet of storage per capita in the U.S. And once you're getting well over that, you start to become a little more oversaturated in terms of supply. And if you're under that, that's a better environment for development or buying a new deal. So yeah, supply ratios and just good locations and good real estate nuts and bolts.
My goodness, you know your numbers. That is very impressive. How can someone get into self-storage to help build their retirement fund?
Well, it's, again, as I mentioned earlier, it's operationally intensive. So you really have 2 options. You could go out and buy your own storage deal, and you have to be ready to kind of learn. You're not going to learn all this in a book or on a podcast or anywhere else. You have to actually go out and do it. Some deals that are smaller and in more secondary and tertiary locations, maybe you could buy for $500K. And it's not huge, but it's a storage facility. There's good income in place. You could do SBA financing. If you're an owner operator, the SBA will lend on storage up to, I think, 85% of value. So your leverage is a little bit higher doing that. And just be ready to learn how to operate. You have to set up a call center, security cameras, gate systems, property management software to track your revenues and who moves in and moves out, customer service. But I mean, the first time you do a new deal type is the first time you do a new deal type, right? And the other option is to buy stock in self-storage. You can buy Extra Space, you can buy CubeSmart, you can buy Public. They're publicly traded stocks. You could sell them tomorrow. And the third option to get into self-storage is invest in private syndications and funds. And there's a lot of them out there. Just like anywhere else or any other asset class, some sponsors are better than others, some strategies are better than others, some terms are better than others. But those are really the 3 ways to participate.
So dumb it down a little bit for syndication, for example, because I have heard of syndication for, say, apartment buildings, and you have investors come in and they get a check once a month, and then if it's sold, they get a percentage of the sale price or whatever. How does it work with storage units, facilities?
It's really identical.
Okay.
So there's really 2 types of vehicles out there in private real estate. There are syndications and there are funds. And a syndication is typically a single asset deal. The sponsor will form an LLC, put together a private placement memorandum, an operating agreement, raise capital to fund the deal, source bank debt, they'll go operate it, they'll make distributions, eventually sell and pay profits to investors. A fund is identical to a syndication, but a fund is a collection of assets. So you're not investing in one specific deal, you're investing in a portfolio. And we do syndications and funds, and they both have their advantages and disadvantages. But one of the reasons we like a fund is the kind of geographic and cash flow diversification that a multi-property portfolio offers versus one deal. So inevitably out of 10 deals, maybe 2 are behind forecast, 6 are on forecast, and 2 are ahead, and they kind of balance each other out. Versus a single asset syndication, if the deal doesn't go well, there's nothing else to prop it up. You're just in that deal, and if it's not going well, there's not other income streams from other assets to kind of shore that up. But typically the structure, as far as like there's a preferred return component, which means investors get the first round of dividend up to a certain number. After that happens, there's typically a split with the sponsor and with the investors. And structurally, self-storage fund or syndication is really identical to a multifamily fund or syndication.
Okay. And what's the typical percentage that they're earning off their like interest that they earn?
Yeah, total returns, generally sponsors these days, if you're targeting, whether it's self-storage or something else, if you're targeting a deal that's a little bit lower risk, that's more stabilized, you're not really doing development or heavy value add, total returns to investors might be a 12. If you're targeting a deal with a little more growth, and a little more risk, but a little more upside, total returns to investors might be 17 to 20 over the life of the vehicle. So we're mainly doing the latter. So we target returns between 16 to 18%, somewhere in that range over the total life of the fund. And that return profile is something people need to understand before they invest in something, and they need to understand kind of what's driving those assumptions. Like let's say you're looking at two different syndications. One says you're going to get a 20 and one says you're going to get a 15. You're probably going to think, oh, I'll invest in the one with the 20. But it could be a lot higher risk. And that total return profile might be predicated on some big event happening years down the road that's really tough to predict or quantify.
Right.
So a better return target doesn't always mean it's a better deal.
Excellent. And well said. So how can someone like me start investing and help to build my rental portfolio or just my portfolio in general?
Well, most syndications and funds will accept a variety of different types of capital. We won't go in the weeds on this, but one type is individual retirement accounts.
Do you have to be like accredited?
Depends on the type. Some designations allow for a certain number of unaccredited investors.
Okay.
Others require accreditation, which means you're worth $1 million outside your primary residence, or you make 200 grand a year if you're single, or 300 grand a year if you're married.
Gotcha.
So that's the kind of accreditation burden. So it varies. Most funds and syndications require accreditation. Beyond that, the process is pretty simple. Depending on what sponsor you invest with, you obviously got to do your diligence on the sponsor, understand their track record, make sure their splits and their fees they're charging are market clearing. They shouldn't be egregious. Like if the sponsor is keeping 90% of the upside, that's probably not something you should do.
Right.
And then, once you get comfortable with the relationship, because it's a partnership, and depending on the duration of the deal, you're going to be partners for better or for worse for a long time. So understanding who you're working with is important. And once you establish that relationship, it's pretty simple. You go into, most of us have investor portals. You go online, you fill out documents, answer some questions, get a copy of your W-9 for tax returns. And then when the sponsor issues a capital call, you fund your investment and off you go. You're partners.
W-9s, man. We just went through a whole stack of them.
It's that time of the year. We did this. Yeah, we had a big fire drill in our office trying to get some of these things tied out a couple of days ago.
So what's the typical length someone can park their money with you?
It varies from strategy to strategy. We've made a lot of mistakes in our real estate careers, as we all have. And I think one of those consistent mistakes has been being overly transactional, meaning buying, making better, and selling too often and too quickly. And you build cash doing that, but you end up paying a lot of taxes. And then once you have that liquidity event, you have to take a new round of risk and redeploy that capital somewhere else. So we've shifted our thesis a bit in the last 3 years to being more medium to long-term cash flow investors, with, of course, upside and capital appreciation. But in our deals, on average, we target about a 7-year hold period.
Oh, okay.
From acquisition to disposition. And we're not necessarily married to that exact figure. It could be more, it could be less. But if a sponsor is running their operation efficiently and making the right decisions on their capital stack, meaning their debt financing, their equity, there's a number of scenarios where investors can get their money back before properties are sold. And that could be from a refinance or from distributions from excess cash flow. So point in saying that, I guess, is the hold period is not always tied to when an investor gets their money back.
I'm so glad you brought that up, because as an investor myself, we also do some private money lending, and you get to that point where the deal that you lent on is getting ready to be sold. And then you got to start thinking, where am I going to park this money for the next, 6 to 8 months? And yes, there's some quick money in there, but there are times where we can't find a deal to place our money quick enough. So I love that. 7 years is actually a really nice sweet spot for many people who are listening. So awesome.
Yeah, private lending is a great strategy, and we have a lot of associates in the business that focus on private lending. We've done some private lending too, but really, the only problem with it is if you deploy, let's say, 100 grand into a private note, and it's paying you a 10, and they pay you off in 6 months, you didn't really make a 10, right?
No, correct.
Yeah. And then you get your money back, and you have to find another person to lend it to.
And listeners, that means it's an annual percentage rate. So you're getting 10%, but you're only making, 10% off. So that'd be 20, 25. What am I do my math here?
Yeah. If you had it out for a year at 10% on 100, you would make 10 grand. But if the borrower pays you off in 6 months, you would make half of that, which is 5 grand. So you didn't make 10%.
All those zeros confuse me. I talk.
Right. Yeah. Zeros are tough. Yeah. I agree.
I was a music teacher. I married a accountant just because that's what I hate the most, is working with numbers. So thank goodness I just have him do everything for me. So
that's a good complementary team there.
Yes, yeah. He's so lucky. It's his birthday today. So Jacob, thank you so much for going through and explain that. It started clicking for me a lot more. I've had people on here talking about self-storage facilities before, and I actually like your spin on it now, where I could just throw some money your way, park it for a while, and you work with, investors from all over. So that's awesome. How can people find you to maybe invest with your company?
Well, before I give you that, I'll give you a few disadvantages of investing in private syndications or funds.
Okay.
So talk
me out of it. Why don't you? Go ahead.
Yeah, sure. No, it's good. It's good to know both sides, right? The first disadvantage is you're a member of the LLC, but you don't really have any voting rights. So if the fund is buying a deal in a market you don't like, you can certainly voice your opinion, and the sponsor will probably consider that, but you don't really have a lot of control. So you're very passive. But a lot of people like that. They want to be passive. They've got a full-time job. Maybe they're a high W-2 earner, and they work 60-hour weeks. They don't have time to go out and do their own storage deal.
Right.
The other disadvantage is, generally speaking, depending on the fund or syndication structure, the other disadvantage is investors have a lack of liquidity. So, for example, if someone wants to get out in 6 months, it's not like selling your Amazon stock and getting a wire to your Schwab account. Depending on how the sponsor is set up, there's mechanisms where someone could potentially get out early. But in general, to a degree, you're kind of stuck, for better or for worse, for a while. Now, of course, you're stuck getting cash flow and tax advantages and eventually upside. Those are really the two kind of drawbacks to passively investing. But the upsides to it are, as the passive investor, you're taking most of the upside, depending on the structure. You're participating in all of the tax advantages during the hold period, pro rata with your contributed capital. And the most amount of work you have to do is, an hour Zoom call to sign subscription documents. And then you get money pushed to your bank account every quarter. You get a K-1 in March, and your money's working for you.
Sounds great to me. So thank you for explaining that. So tell people how they can find you.
Yeah, they can go to our website, which is VanWestPartners.com. They can email me, Jacob@VanWestPartners.com, or hit me on LinkedIn, Jacob Vanderslice.
Awesome. And you heard me at the beginning of the episode do a badassery bestowment. Do you have a badassery bestowment you can share with my listeners?
I appreciate the bestowment. Thank you. Yeah, so I guess, generally, some of the best advice I've ever had, there's really two things that I'll kind of share that helped me towards becoming a badass, which I'm not yet, but hopefully I am someday.
Oh, you are a badass.
Thank you very much. One of them is accumulate cash flowing assets. And there's a time and a place to sell them. But if you can be disciplined enough to hold and you can hang on, I believe that's really how wealth is created in real estate. Being transactional builds capital, but being transactional, I don't think necessarily creates wealth. I mean, there's some big deals out there. You build a massive apartment building and you sell it for a 4 cap, you might create some wealth there. But I think holding assets for the long haul and enjoying the tax advantages and recurring revenue streams they produce is really kind of the path to wealth creation. And the second piece of advice that I've been given, and I forgot who told me this many years ago, but it's take action, take risk. There's no perfect deal. A lot of people I talk to, they go to seminars and they read books and they're just waiting for that perfect deal to show up. And there's never a perfect deal. And if you do find a perfect deal, you don't know how perfect it is until well after you bought it. The home runs we've hit were totally unexpected. And the same with the failures we've had too. You don't expect to fail, but take action and take some risk. And if you take a few lumps on your first deal, so you buy a fix and flip or you buy a storage facility, you'll learn from that and you'll never forget it, and you'll apply that to the next deal you do.
So take action.
Take action, take risk.
So important. And I was so afraid of that in the beginning. I had that analysis paralysis, just like you said. It took me 6 months before we got our first deal. And then once we got through the motions and did it, it was just so much easier. And absolutely, I wish I didn't waste those first 6 months. So thank you for sharing all of that. That was a great badassery bestowment. So the second part of the podcast is what makes Jacob Vanderslice a badass. And I use the acronym BADASS. And the first word is book. So what is a book that's made a huge difference in your life?
Well, I've been on a number of podcasts and I've mentioned this book, and I think I need to find a new book because I've mentioned this too many times, but it's that good. It's a book called In the Kingdom of Ice by Hamden Sides. Oh. And I'm guessing a lot of your guests will mention like, Good to Great or Rich Dad, Poor Dad.
Rich Dad, Poor Dad.
Or Traction or whatever. And those are all great. I'm not good at reading business books. I mostly stick to historic nonfiction. I just can't get through business books very well. But this book is about early 20th century polar exploration. And these guys thought that if they got far enough north, the snow would melt. They could go over the top of the globe and get to Asia and Russia. And obviously they got north. They found out that the ice was still there and getting worse. So they were frozen in the ice for a long time. And they ended up walking out on foot over 1,000 miles into Siberia. And a big piece of the team passed away. They were left behind. Other people went for help. And the folks that went for help walked well into Siberia and came back for their buddies. And the story, the survival story, eating the leather off your shoes, getting scurvy, the weather they encountered, it makes any bad day that we're having in our conditioned homes or our offices just seem relatively meaningless. So it's a very inspirational book. I gave copies to our entire office, and most of us agreed.
And it took place when?
I think this was either very late 1800s, early 1900s. Off the look. Yeah.
Wow. Well, thanks for sharing that. I love hearing different books. So thanks for that. The first A, and you already gave us some advice, so maybe you have another piece of advice, but I use the word advice. What's the best piece of advice you've ever received?
Well, I kind of mentioned those earlier.
Yes.
I guess, one brief snippet would be, as you evaluate taking risk and doing your first deal, the best you can do, which we talked about before we started recording, is quantify the upside, meaning reasonably forecast how well this deal can do and have a decent margin in there. And the other side of it too is mute the downside. So if things get nuclear, can you make your interest payments? If the market dropped a lot, would the market drop below your cost basis? So yeah, just simply quantify the upside and mute the downside. And the assumptions are only as good as what you put in, right? You have to believe what you put into your model and into your assumptions. And as we all know, the spreadsheet will tell us whatever we want it to. You just have to believe what's in there.
Spreadsheets. That's the other thing with my husband, is he loves a spreadsheet. So I love that advice. So one more time, it's quantify the upside, mute the downside. I like the mute the downside part.
You got it. Mute the
Yes.
downside. And I would say muting the downside is more important than quantifying the upside.
I like that. All right. The D in badass is drive. What drives Jacob to be successful?
I really enjoy the thrill of a new acquisition.
Oh, yes.
I love all the assumptions you make, the effort in getting the deal controlled, the forecasting, raising the capital around it, getting the bank financing in place, just all of the steps leading up to when a property is identified and when it closes. I think it's a lot of fun. And then once you close, now it's up to you to deliver on the assumptions you made in your model. Again, quantifying the upside, meaning the downside. But if you thought you could buy this property that's 50% occupied and lease it up to 90% 2 years later, well, you bought it. So now you got to do what you said you would. And we really enjoy that.
I do enjoy the chase of a deal. And then I get so excited once we get under contract, and then I'm sweating until we get the financing under control. So It's like just up and down. But yes, that is a thrill. All right. The second A in badass is aspiration. I'm a big goal setter. So what's a goal you're currently working on?
Yeah, we're launching 2 new storage funds with pretty aspirational capital raising targets, and we have a business coach. I know you do some coaching yourself. Mm-hmm. He always tells us that if the goal isn't kind of scary, it's not high enough. So these goals are kind of scary. Can we get there? Can we find the deals? Can we raise the money? So this year and kind of moving forward, it's going to be a continued focus, kind of like last year, on deal flow, capital raising, and our operational platform, which is our self-storage management company. So you need all 3 of those things to be successful: deal flow, capital to buy the deals, and you need the team to operate them.
And VanWest is a successful company, and yet you went back to my badassery bestowment, and you mentioned you all have a business coach, and it's so important. Just like I said, all the successful people know that you have to continuously feed your education and your knowledge. So glad that you mentioned that. Awesome. All right.
Yeah, between our coach and our masterminds, we spend a lot of money each year.
Absolutely.
And you can't necessarily put a dollar figure on that ROI, but it's made us exponentially better people and business owners and operators.
1,000%. I'm headed to Vegas on Tuesday for a mastermind myself. So I'm going into commercial multifamily. So it's just like the next progressive step for me. I want to just dive in, and I'm spending a ton of money for this program, but it's going to come back tenfold. So awesome. I'm glad you said that. All right. The first S in badass is systems. What systems do you have in place to help you achieve success?
We have a lot of systems, but one specifically that comes to mind is a software program called HubSpot. Mm-hmm. We use that for our CRM. We started using it about 2 years ago, and we've gotten a lot better at it, but I'm guessing we're still using only a small percentage of its capabilities. We use that for our email marketing, for our lead tracking, investor reporting. It's a really great platform, seamless to use. So that's kind of one of our main daily multiple times a day tools that we use.
Awesome. Yes. Very important to have a very good CRM to track everything as well. All right, Jacob, we're at the last letter in badass, which is success. What does success mean to you?
Success for me has evolved over the years. It used to be, when I was younger, kind of more money driven. I just want the most money I can get. And it's not the case anymore. I think if you could put a money spin on it, I would say that success for me is it's durable, recurring, repeatable revenue streams that are just recurring and constantly coming in. And if you have that, which we're still working on for sure, that enables you to spend the time that you have, which is very finite, the way you want to spend it, with family, with friends, traveling, doing whatever. But I think passive income is, to a degree, freeing.
Absolutely. Absolutely. 1,000%. Thank you so much, Jacob, for being on the show. One more time, how do people find you, say, on social media?
LinkedIn. I don't have a Facebook account or anything, or Instagram. I just never got around to it. But yeah, LinkedIn, Jacob Vanderslice, or go to our website, VanWestPartners.com.
Awesome. Thank you so much. And that is all. Thank you for listening, and we will catch you on the next episode. Now go out there and share your badassery. And don't forget, make it a great day. Take care. Bye-bye. Whoop, whoop.
Thank you for listening to RAIN, the Real Estate Investor Growth Network. Be sure to subscribe on your favorite podcasting platform so you never miss an episode. If you need more badassery, you can follow Jen Josie by visiting therealjenjosie.com or become a member of RAIN by registering on rainmastermind.com.